So for decades, we've been told to follow the 4% rule. That means if you withdraw 4% from your pension each year, rising with inflation, it's unlikely that you're going to run out of money. But here's the problem. It just doesn't work anymore. And that's because the 4% rule was designed for a world that no longer exists. If you just follow the 4% withdrawal rule, you might not be living your best life in retirement on your terms, and you might even have to sacrifice some of your lifestyle as a result. Worse still, you could be leaving too much money on the table for the HMRC to collect in inheritance tax. In this week's video, I'm going to explain why the 4% rule is broken and what you should consider doing instead. If this is your first time, a very warm welcome to the channel. My name is Simon. I'm a chartered financial planner with decades of experience helping hundreds of clients and their families prepare for a better retirement. Now, we all know that money matters, so let's try and make money make sense. So without doubt, one of the most frequently asked questions from clients as well as potential clients is, how much can I take from my pension when I retire? Now that is a very, very big question. It's going to vary from person to person as retirement is different for everyone. Now, it does help to have some guidelines and some rules wrapped around this complicated subject. And probably the most well-known of these is the iconic 4% withdrawal rate rule of thumb. Now, this guideline suggests that you can withdraw 4% of your retirement savings each year, increasing by inflation, and that would mean that you wouldn't run out of money over a 30-year retirement. Now, I'm going to explain some of the flaws in this rule of thumb. Some of these have been highlighted and identified by Bill Bengen himself, as well as what you might consider a more appropriate withdrawal rate, but that's going to be towards the end of the video. Now, Bill Bengen was an aeronautical engineer from MIT before he became a financial planner. And he analysed US stock market data since records began using a 50-50 equity to bond or a balanced portfolio up to 1994 when he devised and invented the 4% rule. Now, it's also worth noting that recent analysis by the Trinity study have also shown that the 4% rule still has a very high probability of success, especially with portfolios with higher exposure to stocks and shares. Now, Bill Bengen himself acknowledged that the 4% rule has its limitations, that is not designed to be a one-size-fits-all solution, and importantly, the 4% rule has been used far too simplistically. Now, in an interview in February 2021 on the Rational Reminder podcast, he noticed that the 4% guideline was intended as a worst case scenario for pensions in America, using a hypothetical example of someone who retired in 1968 at the peak of the stock market before they then had a protracted bear market lasting almost 14 years, and that went hand in hand with skyrocketing inflation which lasted throughout the 1970s. Now, in that scenario, the 4% withdrawal rate still allowed the investors' funds to last 30 years. Now, Bill Bengen has also stated that a sustainable withdrawal rate based on historical data could also be closer to 7%, and at other times the withdrawal rate could be as high as 13%. That would have been possible. Now, clearly, all this is based on historical and backward-looking data. It's also based on the year that you decided to retire, and importantly, the asset allocation of your portfolio. So please, don't just go out now and automatically withdraw 13% of your portfolio and think that you're going to be okay. But that does bring us very neatly to some of the flaws in this 4% rule. So number one, it assumes that our spending patterns are going to stay exactly the same and linear during a 30-year retirement. And we all know we're going to hope to spend more in the early years when we're going to be hopefully active enough to enjoy the money. So for example, if you gave £10,000 to someone in good health age 65, it's going to have more value to them because they can do more with it, as opposed to giving £10,000 to someone age 75 in poor health who might not be able to do as much with the money. So number two, it also assumes that we're all looking for a 30-year retirement. But if you're a man age 65 now, according to the ONS, you're going to have an average life expectancy to age 85, and with just a 10% chance of living to age 96. And that's a 31-year retirement. That's just a 10% chance of having a 30-year retirement. Number three, it also assumes that we're looking for 100% probability of success with our withdrawal strategy. Now, you might be willing to accept a far lower probability of success, for example, 80%. If that was the case, you could consider withdrawing a higher percentage in the early years, but understanding that the pension fund could run out sooner than expected. And if you take a quick look at this heat map, you can see the probability of success of a withdrawal rate based on the portfolio mix. So for example, a portfolio with 50% equities and a 5% withdrawal rate has got a 79% chance of success of lasting 30 years. And if you're happy taking a higher level of investment risk, for example, 80% in equities with a 6% withdrawal rate, this is going to have a 66% probability of success of lasting you 30 years. Now, of course, it's worth mentioning that no one knows how stock markets are going to perform around the world in the next 30 years. So this rule can very easily lull you into a huge false sense of security. Number 4, this rule is way too conservative, as even in the worst case scenario in 1968, which I talked about earlier, the 4% rule still worked. So that would mean that you are not living your best retirement on your terms, so you could be leaving more money on the table just for the HMRC to scoop up either in inheritance tax on your beneficiaries, or worse still, in inheritance tax. Now on this channel, we are firm believers that there should be no room for financial regrets in retirement, and knowing that you could have done more, spent more and enjoyed your money more could definitely be one of them. And number 5, the 4% rule, and this is important, doesn't take into consideration platform fees, investment fees, advisor fees, income tax, and it may not be appropriate for a pensioner investing in the UK because this rule was based on US and American data. Now, there is a book that I highly recommend you read, and that's called Die with Zero by Bill Perkins. Now, a 2018 study by the Employee Benefits Research Institute had the following findings. Pensioners that had $500,000 at the beginning of retirement had only spent 12% of it within the first 20 years of their retirement. So what that meant is they had 88% left, or $440,000 at age 85. Now, at the lower end of the spectrum, where pensioners started their retirement with $200,000, they still had only spent 25% of their money in the first 20 years of their retirement. And worse still, a third of pensioners had actually increased their pension values. So instead of spending their money, they were actually too frugal, and they'd actually continued to create wealth during their retirement. Just let that sink in for a minute. So clearly, we all need to be flexible, and we need the ability to adapt. So when our pension fund is falling, we are spending less as well. That means we need to make sure that we can delay replacing the car, the big holiday, or even the kitchen, for example. So what that means is you might have to spend less when the portfolio is falling, but when the portfolio recovers again, you're going to be able to take money out for those big ticket items. Now, talking of these iconic rules of thumb, don't forget to hit the like button and subscribe to the channel. If you have a quick look at the PLSA Retirement Income Standards Summary, we're going to see that a couple who are looking for a moderate retirement may need £43,100 a year. So let's do a very quick and basic case study. I'm going to assume 2 maximum state pensions of £11,502 each. That comes to £23,004. That's going to give us an income shortfall of £20,096 per year. So if we use the 4% rule, we're going to divide that shortfall by 0.04. That means we're going to need a pension value of £502,400. But if we assume a more realistic 5% withdrawal rate, we're going to need a starting pension value of £401,920. And that's almost £100,000 less to start off our retirement. Now, a more simple way to think about this is if you take your income shortfall, you can multiply that by 25 for a 4% withdrawal rate, or you can multiply it by 20 if you're looking for a 5% withdrawal rate. So what other withdrawal options do we have apart from the 4% rule? Well, first of all, we could settle for a lower success rate and withdraw more money, accepting that the money could run out sooner than planned. Next is we could plan to spend less in the later years, for example, after age 75, and that's going to allow us to spend much more in the early years. Now, we could accept a higher level of investment risk as well. So instead of taking a 50-50 balanced portfolio, we could start off with a 60-40 portfolio or even an 80-20 portfolio, which based on US market data could give a sustainable withdrawal rate closer to 6%. We can also take a far more flexible approach and spend less when the pension fund falls. Now, we could also plan for a shorter retirement, as a 20-year retirement plan could mean that you could withdraw just over 5% and even more than that if you're happy to take more risk. So if you're looking at ways to manage your income withdrawals, I've linked a further 2 videos in this series. One is about drawdown for dummies, and another is about whether you should save your money in retirement or spend it and die with nothing. So thank you so much for watching to the very end, for your time and for your patience as always. I'm going to see you all again next week.